Well, greetings everyone, and welcome to the Argonaut monthly video covering October 2024. Now, there are 5 things I want to talk about this month: the UK budget and why the UK will likely have 5 years of falling living standards. Second, Wriston's law and the increasing importance of country factor in investing. Third, the Q3 earnings season and what it's told us about what's going on in China. Fourth, expectations for the Federal Reserve meeting on Thursday. And finally, the elephant and perhaps also the donkey in the room, which is the US presidential election on Tuesday and its likely impact on markets. So let's start with the UK budget. October witnessed the much anticipated first budget of the new Labour government, and they increased public spending by another 70 billion per annum and tax by 36 billion. Now, according to the Office for Budget Responsibility, this will take public spending to 45% of GDP and tax to 38% of GDP, which it claims is the highest on record and 5 percentage points higher than before the pandemic. Now, the OBR suggests that this further increase in the size of the state will crowd out the private sector, resulting in medium-term downgrades to economic growth. Now, it's worth pointing out that if we go back to the early 1990s, which in my opinion was the last time Britain was governed well, the private sector was twice the size of the state. Now, under Labour, the state and the private sector will be roughly the same size. It's also worth considering that the state has no incentive to improve productivity, and indeed the big pay rises to the public sector were given without really any agreement for productivity improvements in return, whilst the private sector must earn a profit to survive, and in private sector must also fund the state, which at roughly the same size is obviously becoming a much bigger burden. So the Labour agenda, we think, will accelerate the reallocation of capital from the productive to the unproductive economy. Now, the analogy in fund management would be taking away capital from all those companies that have good ideas and high return on invested capital opportunities and reallocating it on the principle of fairness to those who don't. Now, if a fund manager did this, they would be sacked immediately, unless, of course, he or she worked for the government. Now, this pursuit of equality of outcome has never and will never be compatible with economic growth. As the late Charlie Munger was fond of saying, show me the incentive and I'll show you the outcome. Now, our pre-election views on the impact of the Labour government were set out in our blog, Turning Out the Lights. And so far, I have to say, it contained a significant error insofar as we permitted the possibility of a honeymoon period on Hayek's road to serfdom. In a separate but perhaps not unrelated development, it's also been revealed that Chancellor Reeves' highest ranking banking position was not as claimed as an economist, but instead heading up the complaints department at Halifax Bank of Scotland. This seems rather apt. The Labour government would do well to consider Wriston's law, in that capital will always go where it is welcome and it will stay where it is well treated, given their naive assumption that governments can allocate capital better than the private sector, and the private sector will invest in a country where the government is hostile to a positive post-tax rate of return on useful economic activity. Now, nowadays, fund managers often say that they invest in companies rather than countries, but it's our observation that politics has not only become more important again, but there are actually, sadly, only a handful of countries that are becoming more welcoming to capital. Now, last May, we noted a landslide victory of the pro-business New Democracy Party in Greece, and Greece is now the fastest growing economy in the EU, and its banks continue to be an attractive and undervalued recovery play on that economic recovery. So after 3,000 years, the Argonauts returned to Greece. Now, we were also delighted when President Milei was elected in Argentina last November. And I think that it's a measure of Milei's economic success so far that over the last 2 months, the yield on 10-year Argentinian government debt has fallen from 19% to just 13% in 2 months. The development of Argentina's shale reserves, which would appear to be at least comparable to those in the US, and the remonetization of the economy, where demand for loans is expected to increase 50 to 70% next year off a very low base, are, in our opinion, amongst the most compelling global investment ideas, and we can access them via US traded ADRs. And whilst Milei retains his popularity, we are confident that the government will ensure that our capital is not only welcome, but crucially, is also well treated. UK, take note. Last month in our Bear in a China Shop video, we cautioned against being suckered into Chinese related assets following the policy response intended to get the local stock market up ahead of the 70th birthday celebrations of the communist state. Now, Q3 European and American corporate earnings season has so far been notable for the significant increase in profit warnings related to Chinese demand across many different industries. Now, ominously, this seems as much political as economic as a result of the Chinese shift to autarky. As the CEO of auto parts supplier Aptiv put it, our Chinese customers are demanding only Chinese sourced products. Now, it's probably more palatable to Western companies to blame the cyclicality of the Chinese economy rather than this longer term policy shift in that China will now only buy for the West what it can't yet replicate. And I think this penny is really yet to drop, and the consequences of this for European companies and American companies with Chinese sales are going to be pretty devastating. If we think back to the last Federal Reserve meeting on the 18th of September, the Fed declared victory on inflation, delivering an aggressive 50 basis points rate cut. And back then, the US 10-year Treasury yielded 3.71%, and the 30-year fixed mortgage yielded 6.6%. Rate expectations then were for a further 180 basis points of rate cuts. Since then, however, US economic data has been surprisingly robust, with first estimate of Q3 real GDP coming in at plus 2.8% or 4.6% nominal. Now only 108 basis points of further rate cuts are expected, while the 10-year Treasury and the 30-year fixed mortgage yield 4.35% and 7.28% respectively. In other words, whilst it was expected that the new Fed easing cycle should reflate the US housing market and the commercial property market and make refinancing debt easier for marginal assets, so far the cost of borrowing, given its greater sensitivity in the US to longer term interest rate, has actually increased. Now, this is obviously very important for the housing market, and we also observe that the inventory of new unsold homes in the US is fast increasing. And the market is, I think, anticipating that house builders are trading on trough rather than peak earnings. So if longer term interest rates don't fall, then this could be very problematic for the US house building industry and related companies. So on Thursday, to regain control of longer term interest rates, it might be necessary for the Fed, particularly in the event of a Trump victory, to strike a much more hawkish tone. And really for markets, it may be a situation where markets are damned if they do, and also damned if they don't. Finally, let's talk about the US presidential election on Tuesday. Now, at the time of recording this, we do not, of course, know the outcome. But although polling is close, prediction markets have had Trump's chances up as high as 70%, though these have since come back. Now, it's important to remember that at this stage in 2016 and in 2020, Trump was 4 to 6 points behind in the polls. So if this same bias against Trump exists today, then tied polls or polls where Trump is slightly ahead point to a Republican sweep. In my opinion, if Trump is witnessed outside the lens of mainstream media, he now seems a more effective and charismatic communicator with a deeper talent pool behind him than Harris. And importantly, compared to his previous campaigns in 2020 and 2016. For markets, although Harris is will represent the continuity candidate, albeit we expect that foreign adversaries are more likely to test her mettle, a Trump victory, particularly with a sweep of Congress and the Senate, will likely significantly reshape the global economy in a fashion that we think in general will enhance the prospects for American capitalism, but it will do it in a very disruptive manner through tariffs that will create new winners and new losers. So if Trump wins, which is by no means certain, we will go into some of our ideas on winners and losers in our next video.